660 million pigs in China. There are 34 million pigs in the second largest world producer, which is the United States. So obviously, you know, the need to feed the Chinese pig is even bigger than the need to feed Chinese people themselves. So I think, you know, all this nutrition and this animal protein issues by cattle, I think it's also a great issue. And where we invest, we have to make sure that we invest the right way considering that aspect as well.
Are there any questions from vegetarians in the audience? No burning questions? No comments? No criticism? They're all wonderful? Yes. Okay.
Thank you. This is Elena Viñas from BNP Paribas. I just wanted to make a comment actually on your question around large-scale production versus a small production. When I think we are all clear that this is a sector that is underinvested and is highly needed investment. The question is around how. And we all struggle exactly how to manage our risk, but also how to contribute at the same time of making financial returns. So when we look at the issue, we realize that we're talking about 1.5 billion small farmers in the world, but they're distributed very differently. So one thing is when you look at Argentina, where 20%, only less than 20% of the population is in rural areas. Another thing is when you talk about Uganda, when it's almost 90%. So you can imagine what large production might mean in a country like Uganda. What do you do with all those people? That is conflict. You're asking for trouble. So I think that the key is about really examining case by case, and it's not only in terms of social risk, but also in terms of environmental risk, what sort of fertilizers you might want to invest depending on the soil erosion in the state, the water, whether it is the quality of the water, scarcity, etc. So that would be my comment, and I'm happy to get any response from the panel.
Where did you work before BNP? Where did you work before BNP? Oxford. Go ahead, Abigail.
I only was questioning the logic of what's going on in commodities markets because I do know that ethanol has played a big role in the constraints and the pricing of corn. And corn has not risen more than other commodities, but it seems to have some, at least some basis for its price.
I'm looking at the chart again. There is absolutely evidence that the role of the demand for ethanol is playing a very big role into the setting of the corn price. I mean, I don't have the evidence, but it's basically 10% of the demand. So, you know, it's marginal, substantial marginal demand that is driving the price. And then obviously there is anticipation, you know, of that demand to be altered because of, I would say, the sustainability of regulation for ethanol, from both a subsidies point of view and also from a pure sustainability point of view, you know, traceability about the carbon balance of ethanol, at least third generation biofuels that is at stake. But definitely it's, I think our estimate is basically 10% of the price of corn is made from the demand of ethanol.
Just to add, I think it's a really good point. Corn has this underpinning fundamental issue that you might expect to have led to a divergence, and it really hasn't. And that's the other issue around commodity index funds, is that it's led this increasing correlation of the typical elements of the basket, which, you know, again shows you that fundamentals aren't really driving this process. It's about the investment patterns, but the prices over the last 5 years have all moved so much more closely than they did in the previous 50. Whether, you know, if we are going into a serious second stage of the crisis, if we might see that start to break apart, will be interesting. There's some suggestion that's happening. Whether that means we'll see a greater reliance on fundamentals is not as clear.
Any other final questions?
Kelly has a question.
Hi, I'm Kelly Hess from SAM Group, and my question kind of revolves around the issue of climate change. So basically, if we do get investments and we are able to set up infrastructure in basically equatorial areas, and basically they can succeed for a few years, and then what happens? What are you doing about looking at the risks when the farmland, or basically productive farmland, moves to higher latitudes? So you can maybe be successful initially, but if you're not looking also at the climate change risks, then it could lead to some negative consequences.
Who can answer that?
I don't think I can answer it, but it's increasingly clear that the impacts we expect from climate change are in many respects highly variable geographically and unpredictable within certain boundaries. So it's clearly difficult to predict far into the future the yields that you would expect in certain areas. And how you might move production from one area to another. I don't have the answer to that, I'm afraid. I guess that's something that our climate analysts with more knowledge than I would have to pick up.
I mean, we do a lot of work, and I know Oxfam do too, to be fair, on resilience, so working with communities, given the best forecast that you've got of where the climate is shifting, what you can do within the community. I think it's probably more complex at that level than thinking about an investment strategy, where in a sense you're perhaps less concerned about the impact on people and more just about what the path of profit will be. But actually those two things should be rather more closely linked together than they are being. I think the resilience work over the last 10 years has really taken off. And where you see that being successful, you see you see not only extreme weather events that don't have dramatic human impacts, you also see growing productivity of agriculture despite increasingly difficult conditions, and where it's not there, you see the things that tend to be reported more. How you fit that into the kind of investment models that people look at, I think, is a real challenge, but one that has some, or should give us some cause for optimism.
If I can make another quick point, there is something of an analogy with the financial system, I guess, in that somewhat only that we've had a relatively monolithic financial monoculture in recent years, and that's one of the reasons why the current crisis has been so severe, and that in agriculture, perhaps a diverse and sustainable agriculture, it may be more adaptable and resilient than an industrial monoculture. So that's maybe something to consider.
I just wanted to add something. I think most people do not realize that farming, being a farmer, is one of the highest risk activity on Earth. I mean, if you can imagine all the parameters, all the risk that one farmer has to absorb when doing this business, obviously in a non-regulated context, it's huge. So obviously, the climate change is just adding to extreme weather events is adding to the scope of that. But I think that has to be considered as well from the farm position, and we have to find the right mechanism for that, because obviously there's a shrinking number of farmers in developing countries is a correlation to that issue. So then I think another point is the role of that was not addressed is the point of the major food companies that so far, to be honest, didn't have barely any kind of trading or hedging strategy in place. If you speak to Unilever, they say they didn't have a hedging strategy, and they're only starting to do so now. And that will have a massive impact as well.